alternative investments, alternative investment chapter. And this chapter is coming from the CFA lecturing. It's based on the CFA level 1. Let me share the chat. So, alternative investments. Okay. So everybody knows what is the investment. And if it's not difficult, would it be possible for you to just share what do you understand by the investment when you hear the word investment?
Well, I understand it as some place where you put your money, to like a safe place where you put your money to gain some interest on it.
Yeah, very good. So you put your money and get some gain on it, like profit and markup or interest. So more specifically, investment in finance. In finance field. Like buying and selling the stocks or shares or any financial securities. Could it be considered as an investment?
Yes.
Yes.
Yes, very good. So basically, in the financial market, buying the financial assets could be considered as investment. But this chapter is, let's say, buying a bond. When you buy the bond, so what risk do you face when you buy the bond? So when you buy a bond,
Interest rate.
Interest rate. So what is that? More specifically?
So when the interest rate rises, the price of bonds usually fall down.
Okay.
And this might reduce your portfolio value also.
Okay, what else? So what is the bond?
It's a debt, actually.
Yeah, it's a debt, but when you give a debt, when you provide a loan, what is the risk that you're considering first when you provide a loan?
Default risk of default.
Yeah, default risk.
Risk of default. Okay, this is the risk that you face it, risk of default. This is really what you're concerned about. If you give a loan to somebody, or if you buy a bond, the first thing that could come to your mind, will you be able to receive the money back or not? This is the question you might receive. However, I can give you an example, like we have government bonds versus corporate bonds. Which bond is considered to be riskier?
Corporate.
Corporate.
The corporate bond. Why?
Is government.
Because company can default, but government less likely.
Less likely,
At least, yeah.
but you have not said the government. This is what I like it. But you haven't said that the government will not default. Is there any chance that the government will not default? Do you think that
No guarantee?
there is no guarantee? Is there any example from the real world that government defaulted?
Venezuela, maybe.
Greece.
Greece. Very true, and Cyprus, because the Greece and the Cyprus, they're interconnected. When the Greece was about to default, they got the money from the Cyprus. They didn't borrow, they just took it from the banks and tried to pay their debts when they were time to pay it, actually. However, the consequences was that Greece was not able to pay, and that triggered the crisis, not only in the Greece, in the Cyprus as well. So buying the bonds, it's a risky investment. So if there is a bond and stocks, and you have, let's say, $100 million, the stocks will give you, let's say, 10% return. The bond will give you 8% return. So what would you buy? So what would be your decision to buy, the bond or stock of certain company? And give a clarification. You have $100 million.
I think it's better to buy a stock because when you buy a bond, you'll receive your money in 10 years or 30 years, not in really close future. But when you buy stocks, you can sell them whenever you want and for even higher price, maybe not just talking about twice higher, but maybe 10 times higher price.
So the issue is that you're preferring to buy a stock. Yes, Evgeny, because stock gives you more return.
Yes. More return and more flexible in conditions, how you can sell it.
But what if the stock fails?
Not so much limitations.
What if the stock fails?
You can return your position and short on the stock.
And let me add to this, let's say derivative, like put option, the options. Okay, the options. So, and the option will bring
Yes,
you,
you
let's
can
say,
protect your stocks with options.
sorry?
You can protect your stocks with options.
You can protect with the stocks with the options. Okay, it's one side, but let's say you want to buy not with the protect, but not hedging the options, the shares, but you want to buy and get some profit on that. Is there any idea what would you buy? There's no, the budget is your 100 million. Evgenia said she would buy only.
But it's better to differentiate the portfolio anyway.
Can I add, Professor?
One more time, yes, please.
I would preferably do like this. Let's say 20% on bonds as a safety net and 80%, which of them 75% on stocks and 5% on options. That would be more safer.
Okay, very good. And the Evgenia lastly added one word, what you have just said, Almat. She added
to diversify.
Diversification. So why you should buy only one stock? This is very good, Alma, that you have just underlined. We should buy 3 of them. Why not? If one fails, the other one will be actually compensating the failed one. So this is idea. Okay, this is one case. This is one thing that I could tell you. If you're given like stock 1, stock 2, stock 3, and stock 4. This is, let's say, IT. This is, let's say, airline industry. This is, let's say, manufacturing. And this is airline as well. So there we have 4 different stocks. So we agreed that instead of just buying a single share, it's better to diversify your portfolio to reduce the risk. You cannot eliminate the risk fully. However, you can reduce it to some point, to market risk, let's say, to market risk. At least you could be saving you could just control the specific risk of the company, the firm risk. So in here we have IT, airline industries, manufacture and airline industries. So 4 different industries. So which stocks would you buy then with combination? Would you buy all of them or would you select any of them? Just give your comments, any ideas.
I'll select those stocks which has negative correlation.
Negative correlation. Why? Would you explain your answer?
Because when one stock defaults and goes down, other one will go up and compensate the loss.
Okay, one could say I would buy the stocks which have positive correlation. One would go up, the other one would go up as well, so I can earn profit.
But what if they both go down?
What if they both go
You-
down? Very true. So you just justify your selection with, it's better to go with the negative correlation. Okay, what else? Any, I think Tamerlan was about to say something. Or any idea? Yes?
As you said, we don't need to put all eggs in the one basket. That is why we need to diversify, as it was said. If both of them will go down, or triple of them, actually doesn't matter. We need to save them because all of the stocks have own history. Like it's a technical analysis, as I know. Yeah, and
Okay.
all of them have a history, and we need to wait until they goes up. And
Okay.
this
Okay.
position to
Okay.
sell.
Your answer is clarified.
It-
Okay.
Like trading.
I see. I see. So using some technical analysis that would give you more support in selecting the stocks and shares. Okay, it's justified. But one more question to you. Okay, we understood that we should. Evgeny said we should select the negative correlated. So which industry would be having negative correlation? Like, do you think that IT and air industry would have negative correlation?
Not really, maybe very low, but still positive.
Probably air and manufacturing, airline and manufacturing.
This one? But let's say
But it
manufacturing
depends
the
the type of
cars.
manufacturing.
Why do you think they could have it?
Because some of small things that that airlines need are produced by car manufacturing companies.
Okay, let's make it, it's a just engine manufacturer, but it's not related to the air industry at all. They do not produce anything. We should be more specifically in manufacturing when I say manufacturing. Okay, we should be more specific. Let's make it construction.
So the correlation is zero.
So there's no correlation, yes? But what about Air One industry and this one, Airbus and Boeing? Let's say this is Airbus, this is Boeing.
I think they're
Are they-
negatively correlated.
I
Why?
think they're positively correlated.
No, they're highly positive.
No, maybe when one company suffers, other one can get
But they
higher.
operate in the same industry, which means they have
Yes.
really high positive
I agree.
correlation.
Okay,
Yeah.
I'll wait one by one. Evgenia says negative correlation. Yes, Evgenia?
Yes,
Okay, Alnur says it's a
but-
positive.
Yes.
Okay,
but I mostly
First of all-
rely on supply and demand.
okay, let's
Or-
listen to
or-
you. Why do you think it's negative, Evgenia?
I think it can depend on financial structure, financial statements, what performance both company has. Because if one airline company usually buy planes from only Boeing or from only Airbus, is very rarely when from both these companies. And maybe Boeing has better financial position.
Evgenia,
so
you're
that-
turning around the right answer, but let me give you 1 minute to think, and I will get the justification from Alnur why he's thinking that there is a positive correlation between two airline industries. Yes, Alnur.
So when we usually talk about the correlation coefficient, I think it is considered to be as a common thing for the whole industry, for the whole sector of the economy. And as we can see, these two air companies, they operate in the same industry, and when the industry falls, thus, I mean, the companies also have the recession, and that's why they're, I mean, independent. I mean, they're dependent from each other. That's why.
So they're in the same industry. If industry failed, the whole who are in this industry will fail as well. This is your justification. Am I?
Yes. Yeah,
Okay.
this lot.
Okay. Is there any one else except the Evgenia who is thinking there's a negative? Almat, what do you think?
I think it's positively correlated. I mean,
Okay, we
the
have one
airline
more
industry
positive. Okay,
because the suppliers, customers are more or less have similar characteristics. The
suppliers,
main, I mean,
same
yeah,
characteristics. okay?
suppliers, customers, yeah.
Suppliers and customers with the similar characteristics. So any effect, they would have the same. Okay. Anyone else? Temirlan? I want to hear it.
I agree with Elnur and Almad because
Okay, we have one more negative, positive. Okay.
on the simple example is the pandemic. All air industries pulled down because nobody could travel or something else.
Who benefit from pandemic, Temirlan? Who got the really high pie, the high portion of the pie? Which industry in pandemic?
Air?
No. I mean, who really get the
IT.
benefit, profits?
Knowledge,
Medical.
healthcare.
Medical industry.
IT
Cloud
and healthcare.
services.
Okay, more specifically in education, could you just give a name who
Education.
really gained?
Zoom.
Very good. Zoom really
Yeah, Zoom, Microsoft.
skyrocket. Zoom killed the market actually. Okay, now I will
But
tell you one thing. Is there
nobody-
anyone in the class who says negative? Except the Evgenia. Anyone else who support the Evgenia? Okay, nobody. Let me tell you one thing then. We have market here, okay? Let's say we have Boeing and Airbus. They divided the market to 50-50, let's say. So half of the market belongs to Boeing, half of the market belongs to Airbus. So we have, let's say, 1 billion of the customers, and they are divided 50-50. So the market share 50-50. If this is Boeing and this is Airbus, if the Boeing started to increase the market share, what will happen to the market share of the Airbus?
Decrease.
It will decrease.
If the market share of the Boeing increases, what happens to the profit?
Of Boeing
Boeing,
increases.
Increases. If the market share increases in the Boeing and that leads to increase in the profit, what happens to the profit of the Airbus if the market share is reduced?
It will
Decrease.
decrease.
So what is the relationship? What is the correlation between these two different industries? Sorry, same industries.
Negative.
Negative. So they are negatively correlated. But guys, those who said positive correlation, what you have said is very correct. However, it is applied to pandemic and global financial crisis. Specific. We don't have the crisis, we don't have the pandemic throughout the years. It's just specific of the period of time. So the Boeing like existed 30 years. It doesn't mean that the Boeing existed within 30 years in the pandemic period. So the pandemic was maybe 1 or 2 years. And during this pandemic, everybody was affected, everybody was going down. So basically, in normal conditions, when the market is working normally, same industries, they are expected to have a negative correlation. Okay? This is the reality. If one gains, the other one is loses. Open two markets, open two shops in the same street. They will just share the customers, let's say first years. After that, if one started to attract more customers, now who are the biggest competitors in the world in terms of mobile? Apple and
Samsung.
Apple and
Samsung.
Samsung?
Yeah. Can we say that
Google
both of them
also.
are going to win?
No.
No. The idea is that to capture the market as much as possible, to capture the market share as much as possible. The more customers they get, the more the money they will earn. But it doesn't mean that if the Apple is getting more customers, Samsung will get as well the more customers. So the Apple is trying to show that the iPhones are best, iPads are best, come and buy them. However, Samsung is doing the same thing. Come and buy them. They're trying to just pull the customer towards them. However, so whatever the customer, what if I, for example, I go and buy the Samsung, I buy for certain reasons, for certain characteristics. They're adding the change in modification to just attract. So the game in the world is about the customers. Who will buy which customer? So, however, one thing I want to tell you, if you want to buy a stock and bond with a mixture or any stocks and the shares, if you want to create your own portfolio, you should not create your portfolio with a negative correlation, either negative or positive. There should be zero correlation. You try to avoid this correlation issue. They should not affect each other. So you should buy IT or the money of something which is not the companies that are totally not correlated. Then we call it a diversified, a fully proper diversified portfolio. Otherwise, then what is the meaning of having it? So the alternative investments will give you all the ideas. How could you just make your portfolio investment really diversified, but not with the traditional investments? Traditional investment is purchasing and selling these options, stocks, bonds, other financial securities. But alternative investment is something different. So what is that about? We will see it now. So alternative investment collectively refers to the many asset classes that fall outside of the traditional definitions, which is stocks and the bonds that we agreed. The examples of alternative investment who are being involved in the alternative investments are hedge funds, private equity, real estate, commodities, and infrastructure. And there are some other alternative investment, primarily like they're collectibles. So hedge funds. Have you heard about this word, hedge fund? I'm sure you heard it.
Yes.
Yes,
Yes.
of course.
Yes.
What about the mutual funds?
Yes,
Also,
also heard.
Also.
So what is the difference between the hedge fund and the mutual fund?
one is for
Hedge
very
fund.
rich people. Basically.
Yeah, hedge fund is less regulated also, and more risky.
And more risky. What else? What do you know about the hedge funds and the mutual funds?
The first deposit that should be invested in the hedge fund is much, much higher than a mutual fund. And it would be levered also with leverage ratio in hedge fund.
So which one are more public? What do you think?
Mutual fund is publicly available, but hedge fund is for limited number of people, investors.
Usually, like qualified investors.
Qualified investors. Okay. What else?
Hedge funds, it's more private, while mutual, it's more publicly.
So what they do in both?
They're buying, they're making, they make a huge portfolio of different shares, bonds, derivatives, and then they sell a part of their huge portfolio to investors. And when investor owns a share of mutual fund, it means that investor owns a part of some different shares or even bonds sometimes.
Okay. Okay.
Can I add,
So,
Professor?
yeah, of course.
Also, the hedge funds have less liquidity because you need to wait up to 5 years before you'll get paid.
Before you
While
get paid.
mutual funds, yeah, while mutual funds are more liquid. You can sell it on stock markets.
Okay, very good, very good. So it seems that you have seen this terminology so frequently. So let us go further. Alternative investment differ from traditional investment, first of all, with the types of assets and securities that includes in its. The second is with the structure of the investment, the vehicles in which these assets are held, like use of derivatives and leverage, and invest in illiquid assets and short securities, like opposite to the long position in securities. So alternative versus to traditional investments, how the active management works. They offer high fees, low diversification, narrow the manager specialization, and redemption restriction. You cannot redeem the money at any time you want it. As you said, it's less liquid in contrast to mutual fund. Yes, as you have already underlined that in mutual fund, you can withdraw the money, but in hedge fund, you cannot withdraw that money at any time you would like to. The other features can be added in here to low correlation with the traditional investment, low level of the regulation, and unique legal tax consideration in here. So hedge funds are the private investment vehicles that managers portfolio of the securities and derivatives. They do not necessarily hedge their risk as the name suggests. They are even considered more risky investments because they're taking more risk position. And the reason why they take more risk position in the hedge funds is high returns. The more risk you're involved, the more returns you will get it. Private equity funds are invest in the equity of the companies which are not publicly traded. In equity of publicly traded firms that the funds intends to take private is called private equity funds as well. So financially distressed company, if there's some financial distressed companies and you would like to purchase it with the purpose to solve out that issue and then later resell it at a higher profit, that is all about the private equity funds. Majority of the private equity funds involves in leverage buyout, like using the debt to buy out something and then to resell to make some money on it. Real estate, it's indirectly and directly. Real estate basically is divided into two parts, commercial and residential properties. Commercial properties are bought and sold with the purpose to do some businesses, commercialized. When it's a residential, is with one purpose is to buy and live in it and reside in that property, or just buy and resell it again. So directly, indirectly, involvement in the real estate is either you can buy and sell these properties directly from the construction or real estate companies, or you can just involve in securitization process, like using the financial instruments, like public real estate equity, which is called REIT, or public commercial real estate debt. So you might not buy the flat itself, but you would buy the financial instrument of the real estate. That will show you indirect involvement in the real estate investment. So these are all alternative investments. Commodities like physical product, investing in commodity based on the business production. Infrastructure is referred to the long-lived asset that provide the public services, like an economic and social one, constructing the roads, airports, utility grids, and schools and hospitals. And there are some other alternative investments like collectible ones, like collecting the stamps, automobiles, some unique currencies that really very, very old, some fine wines. And sometimes it is also considered to be as collectible as an alternative investment, buying patents, buying and selling it. So benefit of the alternative investment, first of all, it gives you the low correlations, plus with the high return. You get some tax benefits, return premium for illiquidity because the products are less liquid in contrast to the traditional investments. You get higher return for this. So using the leverage will bring you the higher returns, lower the any variance in the returns. And of course, when the variance in the return is lower, that comparisonly reduce the risk. There are some alternative investment that has got some characteristics. We can divide into four, like different strategies that are used in this alternative investment. The fee structure is a bit different. The due diligence is different when you buy the traditional investment securities, or if you're involved in a alternative investment security, the due diligence is being different, and issuing the wallet and the calculating return is bit different. So these characteristics we're going through now, and we'll just support with some examples. Starting with the hedge funds, like partnership, it provides more flexibility, can be high leverage, and short equity positions or short or long position in derivatives. Sophisticated investors with adequate wealth and sufficient liquidity. So not everybody can enter to this pool of the investors. The fee is based on the managed value of the assets and fund returns. So we will see how the hedge funds, they're earning the money, and how the investor they earn, and how different conditions applied on the management fee, like hard hurdle rate, soft hurdle rate, and so on. So hedge funds are less liquid in contrast to traditional one. The restriction on redemption includes the lockup periods for notice period, like 30, 90 days are given. If you want to withdraw your money, you should have, you should just give inform the manager of the hedge fund that you want to withdraw the money, but prior to 30, 90 days. Extra fees on the redemption, it covers the transaction cost for the managers of the hedge funds. Fund of funds that give the opportunity for the smaller investor to invest in diversification portfolio. So hedge funds kind of make some modification and they create in the pool small funds of funds where the small investor can be involved in. Addition fee beyond the main fee is applied on this fund of funds as well. The four main classification strategies that are used in the hedge funds: the event-driven strategy, relative value strategies, micro strategies, and equity fund strategies. Talking about the event-driven strategies, it's categorized into four, like merger arbitrage, where you buy, sell the share of the firm, which is being acquired or making some acquisition, and you make some money on. Distress, the restructuring, so you buy some undervalued shares of the firms with the pooled funds of the investors. So those undervalued shares are bought of certain company, which is distressed financially currently, and it's a short while. However, when it's sorted out, they will just resell it to make really good profit on that. Active shareholders is another event-driven strategy. You buy sufficient shares of the firms with the purpose to affect the policy of the firm with the goal to increase the value. So if you're a minor shareholder, you buy more certain number of the share to increase to major shareholder status in order to affect the policies of that firm. But the goal is to increase the value of it. And there is a special situation event-driven strategy where you invest in securities of the firm that are issuing or repurchasing the securities. Relative value strategies, it's another strategy of the hedge funds that has been divided into five, like convertible arbitrage fixed income, where they exploit the price discrepancies between convertible bonds into common stocks. So they're trying to get some arbitrage on that. Asset-backed fixed income, like this was very familiar, famous and familiar during 2007, 2009, before actually this global financial crisis. And we can say it was a really good contributor to this crisis that has been triggered out. General fixed income that exploit the price discrepancies between the fixed income securities of different types. Volatility that gives the opportunity for the hedge funds to exploit the pricing discrepancies that comes from difference between returns volatility, which is implied by options prices, and manager expectation of the future volatility. So from these discrepancies, they make some markup. And multi-strategy that lets hedge funds manager to exploit the pricing discrepancies among the securities in asset classes, like different from those previously listed and across asset class which are listed now. So the basic idea, the hedge fund is trying to find a discrepancy between different types of assets. But it can be fixed income asset, it can be convertible arbitrage fixed income, it can be the case of volatility, and which is related to the expectation of the manager. There's another strategy, which is macro strategy based on the global economic trends and events. And this may involve long and short-term position equities, fixed income and currencies or commodities. Hedge funds has got the last equity hedge fund strategies, which is market neutral, fundamental growth, fundamental value, quantitative directional, and short bias. So market neutral, they're using both, or they could use either technical or fundamental analysis to select the undervalued securities, okay? So they use one of the techniques analysis to identify whether the company is undervalued. If it's undervalued, they just go with the acquisition of it or merger. That will let them to get some profit on that. Fundamental growth, they use only the fundamental analysis to find very high trendy growth companies. Then identify and buy the equities of that company that are expected to sustain relatively high rate of capital appreciation, okay? And of course, anybody who buys any shares, even if it's not the hedge fund, they purchase the shares, securities that is expected to go up, but using some fundamental analysis. Quantitative directional, they buy equity securities that is believed to be undervalued and short securities believed to be overvalued based on technical analysis. So market exposure may change depending on the relative size of the long and the short-term portfolios of the position. So basically in the quantitative directional, they use only the technical analysis. Trying to, if it's a long-term position or long-term investment horizon, then they are just trying to evaluate the equity securities with the undervalued status. The short bias, they employ the predominantly short position in undervalued equities, possibly with a smaller long position. However, with a negative market exposure in general. So the due diligence of the hedge fund
Excuse me, Professor.
Yes, please. Yes.
I have a question. Could you repeat the difference between market neutral and quantitative directional? Because both of them more or less similar.
Which one? Market neutral. Look, in market neutral, yes, there could be similar, but it depends on what you're using. In here, you could use both of them, technical and fundamental, or technical or fundamental. So you have a choice to use it here in the strategy. But in quantitative directional methodology, you can use only technical one.
No, I got it.
Okay. Hedge fund due diligence. Do you know what does the due diligence means?
Yes, due diligence is usually like doing work before it starts, like starting to prepare, or like basically.
Yes, very true. Like you're doing investigation. Let's say if you want to acquire a certain company, if you want to buy something, you're doing the investigation of that property or equity in order not to face any problems, okay, any harms or any depreciation in the assets. So selecting hedge funds or fund of funds that require the significant investigation of the available funds, this may be somewhat hampered by lack of the transparency, because hedge funds, they are not easily accessible as mutual funds, so you cannot get all the information easily. The idea is that the hedge funds, they do not share everything publicly. They do not share their, for example, if you want to be an investor, they will not tell you the story, like these are the projects that are available. If you want to invest, let's go and buy it. Because to really get the, let me just explain how the hedge funds works with the example of the car market, okay? Let's say, is there anyone in the class who are interested in the cars, the pricing and everything, or houses?
Not really.
Okay, let me just example give you. Toyota, everybody knows what's the Toyota, yes? The brand. It's
Yes.
a world branded. Any Toyota specific brand that you know, famous? Land Cruiser?
Camry.
Yes, it's a Kazakhstan car. Toyota Camry, okay. Okay, the latest version of the Toyota Camry, what is the price with the full package? Does anyone has got any idea?
17 million.
17
around
million.
8 million.
Let's make it 70 million, okay? Everybody knows that in the market, the price of the Toyota, like mutual fund and hedge fund, they know it. If you go and buy this car, it's 70 million. However, hedge fund investigated the market and find a company which is about to default, okay? And they have, let's say, 10 or 100 of Toyota Camrys, same brand, same model, but with the value they are selling each of 12 million. So is it good opportunity for them to buy it? For the hedge fund?
Yes.
If you go to mutual fund will tell you, look guys, go and put money and into our pool. There is an investment which is this, investment A, okay? With the hundreds of Toyota Camrys, buy them and sell them at 15 million easily, highly liquid, okay? You can make the money. From each, you can make 3 million. This is how the mutual fund acts. But hedge funds, they will not share this information with you. Because if you share this information, anybody who hears it, he will just rush and buy it. Because in this life, anyone who sees any potentials in investment, he does not share the information. Because if he shares, there will be somebody else who will get it. This is the strategy of the hedge fund. Keep it private. If you're an investor, come in, we will show it to you. But we don't show you and then you come in. If we show it to you, then what is the being just private and what is the being and exploring there's something really good potential that could not be explored by anybody else. So we found it, we will buy it only, nobody else except us. But if hedge fund share this information to everybody, then they will lose this opportunity. Somebody will rush and buy it and hedge fund will end up with nothing actually. So this is the idea that hedge fund keeps all the information secret. It's not easily, you cannot it's not publicly available. You cannot see the financial statements of the hedge funds in more detail. what they are acquiring, what they are getting, all the strategy they're using, they are not publicly available as much as mutual funds. So specifically, when they do the due diligence, the investigation of certain company, they check the liquidity position of the company, they check whether the stocks, whether the equity is undervalued. We can see that the equity of this case of Toyota branch is undervalued because they're about to bankrupt, they're facing some financial distress, and hedge fund is about to buy it. But they will not share this information with everybody. They will share only with the existing shareholders. So a partial list of factors to consider when doing the due diligence in the hedge fund or fund of fund includes the following: investment strategy, investment process, the source of competitive advantage, the historical return, the valuation return calculation methods, the longevity, the amount of the asset which is under management, management style, key person risk, reputation, the growth plans and system risk for management, and appropriateness of the benchmark. So these things should be included while doing the due diligence or doing something. Okay, this was about the hedge fund. Now let me talk a bit about the private equity and real estate, and then I will return back to the hedge fund again with the sum calculation example. So the majority of the private equity funds invest either in private companies or public companies. They intend to take it private. So they do just through the leverage buyouts, like using the bank debt or high yield bonds or mezzanine financing. Does anyone knows what does the mezzanine finance mean? Okay, mezzanine financing is hybrid type of securities where debt and equity used together. If financial company is about to distress or is about to go bad, they can easily convert this debt into equity or vice versa. So there are some buyouts and there are some buy-ins. So sometimes you sell it, sometimes you buy it using some management and buyouts. And venture capital is a very highly risky, and this high risk, of course, brings you more return. This is about the private equity. So venture capital with the different strategies, like formative strategy and later strategies. With the formative strategies, it's divided into three, like angel investing stage, then seed stage, and early stage. Angel investing stage refers to the investment made at very early in the firm's life. The firm just started, and often the idea, the stage, and the investment funds are used for business plans, having to access the market potentials. So they have very good potentials to grow. That might be the reason to invest in a very young company. Seed stage strategy, it refers to the investment made for product development and marketing and market research. So it is the stage where the firms is developing different products, doing some marketing, investigation, and some market research. An early stage, it refers to the investment made to fund initial commercial production and resale. So everything is settled down. All the market potential have been researched and selected. Now is about to produce something and to sell and penetrate into the market. Then this is the stage when you invest. It's called early stage in the venture capital. Later stage is the investment refers to the stage of development where the company already has production and sales in operating as a commercial entity. Mezzanine stage financing refers to a capital provided to prepare the firm for an IPO. So the term refers the timing of the financing rather than the type of financing, because when the firm gets to the IPO, it goes out of the private equity fund. So this can be one way of exiting the private equity. And in the later stage, we have committed capital, which is drawn down over the 3-5 years. And the fees on the committed capital is from 1 to 3% of committed capital. There are some private equity exit strategies like trade sale, if you involve in IPO or recapitalization or secondary sale, or some liquidation and write-off. So these are strategies showing the exit from the private equity. I'm not going to very detailed with this private equity and other alternative investment, but I'm going to pay more attention to the hedge fund, especially at the end. But just giving you some information about what is the real estate and private equity as an alternative investment. So investment in real estate can provide income in the form of rents or as a potential capital gains. You purchase a property, let's say in Almaty, which is being constructed. Once it's constructed, it could be rented and give you some money. It could be rented to students. It could be rented on daily basis to tourists, and it gives you this income in the form of rent. Or you could just expect that capital, that property that you have purchased could raise in capital gain. So you can make some money. You purchase for 20 million, and then you're reselling for 30 million. Your capital gain is 10 million in here. So real estate, it provides you diversification benefits to your investment portfolio. So the potential in what could be done in here? You can buy some stocks and shares and invest some money in real estate. So this is how you could diversify your portfolio, fully uncorrelated your assets. So your potential inflation hedge, because rents and real estate will tend to increase with inflation. So once inflation is taking place in Kazakhstan, as you can see, the rent prices are going up as well. So this could be, and the price of the flat are going up. So I can give you the example when the Turkish lira depreciated, like it was 2020, if I'm not mistaken, June, it depreciated by 20%. The price of the houses skyrocketed. Okay, it jumped up very quickly after the inflation, and specifically the rent as well. The same thing can happen in Kazakhstan. Once the currency depreciates, once it loses its value, once there is a inflation, you can see the rents and the price of the housing is going immediately right after the inflation. The forms of the real estate investments is real residential and commercial. Residential is considered direct investment in real estate. And there is mortgage-backed securities, which was popular in 2007 and 2009. It represents indirect investment in the mortgage loan pool. So property purchased with a mortgage is referred to a leverage investment, and owner's equity is the property, or the owner's equity is the property value minus outstanding loan amount. Okay, so that loan is converted into the financial paper when it's purchased on the mortgage. So that financial paper is being traded on market, in the financial market. So this is called a mortgage-backed security. So it's indirect investment on. So buying such instrument, you're indirectly investing in real estate. Commercial real estate properties generate income from rents, like homes purchased for rental income, are considered investment in commercial property, or you're buying some properties with the purpose to establish and shops and so on, or to rent. So commercial mortgage-backed securities represents indirect investment. So any property that you buy, let's say you buy the mortgage-backed security, it could be commercial or residential. It means that somebody who is living in the flat now, it's a residential, or if it's being rented for business purposes, it's considered to be commercial. If you're buying the commercial mortgage-backed securities, you're making an indirect investment, which means that debt, which is based on the mortgages, has been converted into the financial instrument. Later, it's sent to trading to what do you call it, the financial market. So commercial real estate properties can also be held by limited partnership in which the partners have limited liability and the general partner manages the investment and the property. So by the real estate investment trust. So real estate investment trust issue the shares that trade publicly, like shares of the stocks, and real rates, abbreviated as real estate investment trust, are often identified by the type of real estate assets like mortgages, hotel properties, malls, office buildings, and other commercial properties. So income is used to pay the dividends. Typically 90% of the income must be distributed to shareholders to avoid some taxes on this income. Other real estate assets, two additional assets can be considered as real estate, like timberland and farmland, for which one component of returns comes from the sales of the timber or agricultural products. So timberland returns also include some price changes on the timberland, or which will depend on the expectation of lumber prices in the future or how much timber has been harvested. And the farmland returns are based on the land price and how it changes, and the changes in the farm commodity prices and the quality and the quantity of the crops that produce in that farm. So these factors, they affect the other real estate assets. So some potential benefits and risk of the real estate. So real estate performance is measured by three different types of indices. First, appraisal index. Second one is repeat sale index and rate indices. So these are three indices that are used to measure the performance of the real estate. So actually, is there anyone in the class, I don't remember, selected the construction industry for evaluation? Nobody. Okay, I was thinking that somebody could select it, but anyway. So another alternative investment, it's a commodities. So commodities themselves are physical goods like gold, grain, and they incur the costs for storages and transportation. So returns are based on the price changes and not on the income streams actually. The most commonly used instrument to gain the exposure to commodity price are derivatives like future forward options or swaps are available from in all the forms of the commodity derivatives. Futures trade on the exchanges. Some options trade on exchanges while other trade on over the counter. And forwards and the swaps are over the counter instruments originated by the dealers. Some potential benefits and risk of the commodities. So returns on commodities over time have been selected as lower than returns on the global stock and bonds. The Sharpe ratio for commodities as asset class have been low due to this lower returns and high volatility of commodities prices. So historically, correlation of the commodities returns with those of global equities and global bonds that have been low, typically less than 0.2, which is considered to be very low correlation. So adding these commodities to a traditional portfolio can be really a good hedge against any potential risk that could be controlled. So because commodity prices tend to move with inflation rates, holding commodities can act as hedge against inflation, as we talked about real estate properties. Infrastructure investment. Infrastructure investment includes transportation assets such as road, airports, ports, railways, as well as utility assets. such as gas distribution facilities and electric generation distribution facilities, waste disposal and treatment facilities. So other categories of infrastructure investment are communication like broadcast assets and cable systems, socials like prisons, schools, and health and care facilities. So investment in infrastructure assets that are already constructed are referred to as brownfield investment. In general, investing in brownfield investment gives you a stable cash flow and relatively high yield, but offers you little potential for the growth actually. Investment in infrastructure that are to be constructed referred to greenfield investment. Investing in greenfield investment is subject to more uncertainty and may provide relatively lower yields, but it will offer you a greater growth potential in the future. So other alternative investments, like various types of tangible collectibles considered as investment, including rare wines, art, rare coins, stamps, valuable jewelry, and watches and sports memorabilia. So there's no income on generation, but owners do get enjoyment from using, from collecting it. So using different example could be collecting collectible automobile. Like in here, I noticed that many people are trying to collect different very old cars, like even those cars that are left from the Soviet Union. And the price of those cars is very high actually. Like it can be compared with the price of Toyota Camry, the latest version. Like we can give this example, okay? These are the other, so investing your money, not only in traditional investment. So the idea in here is that you should not invest all of your money with traditional. You should mix it traditional with some alternative investment. So that will really fully exploit all the benefits from the diversification and all the reduction in the risks that could be done. Coming to the hedge funds, management fee plus incentive fee earned by the management of the hedge funds. Management fee is the value of that assets under management, like beginning or ending the period. So in cases, there will be some cases that you will be given, you should pay attention whether this management fee is based on the beginning or ending period. And basically, it's a 2% of management fee. If it's 220 in the cases, that means 2% of the management fee and 20% of incentive fee. So management fee is earned in any way, but incentive fee depends on the performance. And there are some terminologies called like hurdle rate. It can be soft or it can be hard. Hurdle rates and high water mark are two types of benchmarks that the hedge fund can set as the requirement for collecting incentive performance fees from the investors. High water mark is the highest value that the investment fund or account has ever reached. So in here, they can get some incentive fee. If the high water mark falls from the previous, then there will be no incentive fee to the managers because they could not perform well this time. And hurdle rate is the minimum amount of the profit returns the hedge fund must earn before it can charge any incentive fee. So the minimum amount it should be charged. Okay, let's say 5%, but your return from using the fund as the manager is 3%, but the hurdle rate is 5%, then don't think that you will get any incentive fee because the minimum amount that profit should be 5%. It even did not reach 5, it just got 3%. So with examples, you could understand better. But this is the example which is given here. I will go through next time, but I will take attendance now. And we will be left actually with 5 minutes. If you have any questions, I'll be pleased to answer. But before that, let me just take attendance quickly. Aidana? Aidana here? Okay, she's not here. Yehyun?
I'm here.
Okay. Evgenia here. Alnur here. Almat here. Arina? Saken?
I'm here.
Anwar?
I'm here.
Dinara?
I'm here.
Dana?
I'm here.
Temirlan?
I'm here.
Okay. Jean?
I'm here, Professor.
Okay. Okay. Took the attendance. If you have any questions, feel free to ask. If not, I will see you on Wednesday then.
Okay.
Thank you.
Goodbye, Professor.
Goodbye.
Okay,
Goodbye.
goodbye.
Thank you.
Thank you. Goodbye.
Professor